Are you ready to start learning investment basics for beginners? Believe it or not, it all boils down to answering 3 very important questions that I'll be covering with you in this video. Wealth Generation Strategies, Frank Thomas here. Welcome. I'm glad you're here with me today. Today I'm going to be discussing what I think are the 3 big questions when it comes to learning how to invest properly. I'm going to tell you what these 3 questions are, and we're going to break them down. So just don't get the 3 questions and go, oh yeah, whatever, and move on. Take some time and listen to the reasoning behind each one of them. You're going to learn something, and I promise you that. So the 3 questions are, it's all about the amount of money you can invest, how long your investment window is, and what is your return on investment. And I've actually got a 4th that kind of caps all of them, and we'll make the last one a bonus. We need to break down each of these factors to learn how you can become a savvy investor. So let's start with the very first question. How much money can you invest? Money will always come from 2 distinct sources in your life, either your paycheck or windfalls. The first one, your paycheck, you need to learn how to slice out a bit of that paycheck every single time you get it. The reason behind this is this way you get to keep a little bit of the money you've made. Now you can say, Frank, all the money I get is mine to keep. But is it really? If you get $2,000 every paycheck and you're getting paid every 2 weeks, but let's say your rent's $2,000 a month, right off the top, you got to turn around and give $1,000 of that $2,000 to your landlord. So did you really get to keep that $1,000? No. You were just a custodian of that $1,000. But wait, you have other bills. What about food? Let's say your food is, let's say $400 every paycheck. Your food and entertainment, let's say $500 to make it simple. Food and entertainment. Now, is that yours to keep, or were you just a custodian again of that $500? It's the latter. So you're down from that $2,000 down to $500. And if you're not careful, it'll all be gone. I ask people all the time, of all the paychecks you made last year, how much did you actually get to keep that's yours, that's still in your bank account? And more than 90% of the people say, none of it. So really and truthfully, they're a custodian to all the money they earned. They traded their time, turned it into a paycheck, and basically blew that time away. What should your goal be when it comes to taking a little bit out for yourself? The goal here is to try to save 10 to 15% of your gross paycheck. You're going to go, oh, how the heck am I going to do that? I can barely keep the wheels on the wagon already as it is. What you want to do is you want to start forming the habit of taking that money out and paying yourself first. Now, the idea here is maybe in the beginning you can only take a little bit out. In the beginning, only I could take a little bit out. I couldn't take 10 or 15% out. It was impossible. But over time, and I learned how to invest, all of a sudden I stopped missing that money that was coming out, and I could take a little bit more off and take a little bit more off and take a little bit more off. And I eventually got myself well into the zone of 10 to 20%. So if I can do it, you can do it. Now, if you think baseball, you got to think that doing this on a consistent basis is like base hits in baseball. So basically, every time you take a little bit out and you pay yourself first, it's a base hit. You get to first base, you get to second base, you get to third base. Base hits, that's what we want. Base hits always win baseball games more than home runs do. Now let's talk about the home runs. And that is windfalls. That's that second source. These are times in life when you get money that you normally don't receive. In other words, it could be a tax return, an inheritance, or anything like that. Something that just all of a sudden you open up your mailbox and there's a check for $500. You weren't expecting it. Now don't go blow it. Save it. Or maybe use the inverse rule and save, take 10% to go have some fun and put 90% of that into your long-term savings. That's what I've been doing for years. I'll take a little bit of it so we feel like we've gotten that windfall, but I take all the rest and put it into long-term savings. It will really boost your how fast you can save. If you're doing these little windfalls, it's not unusual to increase how much you save by 10% or more every single year. And that really adds up over time. So it doesn't matter if it's a large amount or even a small amount. It's all about saving. Now let me tell you about the smallest amounts you can put in. Let's say I have indiscretionate cash every month that we use for things like pizza, going to the movies, things like that. Things that are very indiscretionate. They're not really bills on our budget, etc. Let's say I don't spend it all at the end of the month. Let's say I've got 20 bucks left. I'll take that $20 and put it into our long-term savings. Other than just spending it on something stupid, I go, I didn't use this. I didn't miss it. Let's put it away in long-term savings because I know one day that could be worth $40 or $50 or $60 or more. So why not? Again, this small effort can increase your savings returns year by year by quite a bit. You need to learn to consistently do this for the long haul. This will be the fuel to your financial freedom. Just remember, the goal is to never spend the principal you've put into your savings. Now, I'm zinging this out on the sideline here, but a lot of people don't think about this. They'll save money and go, well, I've saved, $100,000. I can go spend $2,000 on an iPhone. No, leave it there. If you want to take some money out, take some of the interest out from your principal. You always want to be thinking about the fact that you're never going to spend your principal you put in. You're only going to spend the interest. And it's best if you roll that interest back in because that's what really makes compound interest the eighth wonder of the world. Okay, so just keep that in mind. Before we jump into the next question, if you're enjoying this video so far, be sure to give it a like. And if you'd like to see future videos from this guy right here, be sure to subscribe to my channel. I truly appreciate your support and feedback. I'm always looking at the comments, so if you got a comment, leave a comment. I'll be glad to answer if you have any questions. Question number 2. How long is your investment window? In other words, how many years do you have before you'd like to start to reap the rewards of interest from your investment? The longer the window, the better. And this is the reason why I harp on younger people when they're in their late teens, early 20s, start saving, even $50 a paycheck, $100 a paycheck. Get into the habit of start saving that and watch it grow. And they're like, well, that's my money. And it freaks them out and everything. But I've asked them that magic question. All the money you made last year, how much have you got sitting in your bank account? Most of them say nothing. So I said, really? Without you turning around and actually making that manual effort of saving that money, you're going to have nothing at the end of the year. So I'm helping you have something. Start putting it away. The longer the window, the better. As the power of compound interest can substantially increase your capital that you've contributed. If you have a long window of opportunity, wow, you don't got to put a lot of money in. Now, if you're 55 or 56 like I was and go, wow, I got to save, my window of opportunity is very small, which means I have to work really hard to get what I need to actually have something worthwhile into retirement. But if I started at 20, within 20 years of contributions, I'd be done. And I'm dead serious. And I think about it now and I think, oh, that was so stupid of me. Think of it as a tree. In the first few years, a tree doesn't grow a lot. You get a sapling from the nursery, you plant it in the ground, it grew a little bit, maybe a foot. Doesn't look like very much. But the longer that tree has time to grow, the more it will grow each and every year because it's going to get bigger and larger. And even though it still only grows a foot or so, that foot looks huge 20 or 25 or 30 years down the road. It looks huge. When I started investing into my investment account, I was getting dividends, wait for it, dividends of about $10 a month. Not very exciting, I'll just leave it at that. But I knew with time it would grow. And I'm pleased to say that it grew to a high of $2,000 a month. Now that's getting exciting because now I can actually see it's overtaking how much I'm investing, for crying out loud. It's able to put more in than I can every single month. That's really exciting. Having a window of at least 10 years is a good starting point, but if you have a longer window potential, it will make a substantial difference for you in the long run. Let me give you an example. What I'm going to do is I'm going to create a basic scenario here. Let's say I have a 10-year window for investing, and I'm going to invest $500 a month to keep it really simple. And let's say I'm getting a 10% rate of return every single year. What is that fund going to be worth after 10 years? Exactly $102,422 and change. You would say to me, how much of that did I put in? $60,000. The other $42,000 and change is interest. Isn't that exciting? But let's say I did the same thing, but with a 20-year window. And I was still investing in $500 a month for 20 years instead of 10. And yes, I realize I'm going to put about $120,000 into it. And I'm still going to get my 10% rate of return. What is it going to be worth? Exactly $259,684 and change. And an interesting note is in the final years, the interest is contributing almost 6 times more than I'm contributing. So it's literally generating well over $3,000 interest every single month. And I'm still just putting $500 in. And you'd say to me, well, how come it's just not double of the $120,000 on the first figure? The reason why is that initial 10 years of investment is also collecting interest for you, and it has that extra 10 years to increase in value. That's how you get so much more. And I tell you something, if this went for a 30-year window, the numbers are crazy. I'm not even going to get into it because it's going to make this video very long. Needless to say, the longer the window that you can create for investing, the better. But let's look at the third very important question we need to answer, and that is, what is your rate? What is your return on your investment? In other words, what is your rate of interest? How much money are you making without you adding to it? This can be a range, and it will be, but the low end of this range should never be below your average rate of inflation. Now, rate of inflation, what happens is that this is eroding the value of your spending power on money that you have as the price of things go up. And a good example is, let's say I saved $100 to buy a gadget, and I could have bought it today. So I took the money and put it in a drawer. I'm going to buy that in a year. I go to the store in a year, and all of a sudden that gadget's now $105. Not $100 anymore, so I have to add another $5. That doesn't sound like much, but it adds up over the years. So you've got to make sure that your low watermark when it comes to investing is your average rate of inflation. And it's very easy to find out. You can do a search on Google. I discovered my average rate of inflation in Western Canada is about 3.3%, and it's been like that for about 20 years. So that's my low water mark. Now, we want to make as much interest as possible without losing principal we've put into it. The putting in a whole bunch of money into an investment that's a little shaky, a little risky, that's promising 100% return is absolutely of no value to you if you lose the principal in the process and you don't get anything for it. I've done that. You don't want to do it. Don't buy the t-shirt. Don't buy the hat. Don't buy any of it. You don't want any of that. Remember the saying, if it's too good to be true, it's not true. Anybody who's toting extremely high rates of return are telling you a wonderful fiction story, and the money is just going to disappear. I've done it a few times, and I avoid it like the plague. I look for good and what I feel are safe things to invest into. And one of them, to me, is the U.S. stock market. Now, the U.S. stock market has what's called the Strong and Poor 500 or the S&P 500. These are the top 500 stocks in the United States. And the average return between all those stocks and the S&P 500 floats around 10%. Depending on who you read, some say 9 to 11, so I just said 10. Let's be safe. But you can do better with other financial vehicles. One of them that's getting a lot of attention right now is something called an exchange-traded fund or an ETF. Now, an ETF is a lot like a mutual fund with very low fees attached to it, and it's a basket of other funds, like other stocks or bonds and stocks or a variety of other financial instruments that are put into a basket. And this basket is usually stipulated by the criteria of the fund company that creates the ETF. And now there's quite a few that focus specifically on the S&P 500. Now they have other ways to increase their rate of return other than just stock value and dividends. They can use other stock methods to increase that rate of return, and they do. In my opinion, ETFs can realistically create returns in the 10% range and actually beat that. My overall portfolio is generating a rate of return based upon dividend returns only. Now, I'm not talking about ups and downs, just dividend returns of about 15 to 16%, which is pretty good. So why does this matter so much, getting a higher rate of return? There's a rule called the Rule of 72, and I'm going to just touch into it very quickly here because it gives us a pretty good idea of how long an investment will take to double based upon our interest rate. For example, we would take 72 and divide our interest rate into it. For example, let's say we took 72 and we're getting 5% interest. It will take 36 years for $1 to turn into 2. Okay? Now, if it was 10%, 72 divided by 10 is 7.2 years. So in 7.2 years, a lot faster, it turns $1 into 2. Now, let's say at 15%, what does that turn into? That 72 divided by 15 turns into 4.8 years. So in under 5 years, you can take $1 and turn it into 2. So with a 10-year window, you can take $1, turn it into 2, turn it into 4. This is why it's exciting. If you had a 20-year window, $1 turns into $2, okay? Turns into $4, turns into $8, turns into $16. Because it gets a chance to double 4 times from the very first payment that was put into it. So that's why compound interest is so darned exciting in my books. Use the Rule of 72 to guide you, to tell you how long it's going to take to double your money. Very simple. Some people say it's not terribly accurate, but I find it's pretty good. But in the end, the whole thing, the takeaway here is same amount invested, but very different results. What is the bonus I was talking about in the very beginning? The bonus is, what is the most important factor of all of this? There's no one single important factor other than the concept of consistency. Now, I've been touching into this factor as I've been talking about these points, but consistency here is king. This is going to be a journey of a few years, so you need to turn these things that you're doing into habits. Now, the cool thing is, the longer you invest, the more skilled you're going to become as an investor. And that's going to make your rate of return higher and higher over the years. Good example, in the beginning, I wasn't barely making anything. After learning the basics of dividend stocks, I was earning about 5 to 7%. Now, 4 years later, I'm returning 15 to 16%. Tomorrow? I don't know. We'll see. I will always become a better investor. Always be thinking about your future self as well. I have an expression that I like to use: don't rob from your future self. Start using those 3 points. Save, be consistent, and save as much as you can and get the highest return you can, because it's going to be worth so much more to your future self. I have a question for you before we wrap up this video. Will your future self be working until you drop dead? Or will you retire at 40 and live the life you've only dreamt about? It's a really good question. And I have another question for you. Do you feel that you're in a job that's a bit dead end? In other words, you can't even save enough money. You can't even put these rules into action because you can't even save enough money. Maybe you're in a just over broke job. Just over broke, get it? This video that's going to come up on the screen is talking about that very concept. And not only that, how you can get out of that and flip the tables on it and make it become exciting and rewarding. So if you want to, check that out. It's my Just Over Broke video. Otherwise, thank you so much for joining me. My name is Frank Thomas, and we'll talk to you again soon. Ciao for now.